Hello, everybody. I am here with Mark Sunderland from the Sunderland Group today, and as a special guest, I'm really excited to have Mark here as my personal accountant and CPA. So, Mark, thank you for being here.
Thanks for having me.
Yeah, why don't you do a quick introduction
Sure.
on yourself and your company, if you don't mind.
Yeah, so as you said, I'm Mark Sunderland. I am owner of the Sunderland Group. We're a small business accounting and business advisory firm. So we provide small businesses with accounting, bookkeeping, payroll, tax planning, tax prep services, as well as a lot of business consulting. So
Yeah, awesome. Well, on that note, this isn't a business consulting conversation today
No.
necessarily, but the topic that I wanted to ask you about is really kind of helping to explain the difference between selling a primary residence versus selling an investment property or a rental property. Because I get this question asked a lot, believe it or
Sure,
not.
yeah.
The idea that somebody sells a primary residence, they have a large gain upon sale, given the significant home appreciation we've seen,
Yeah.
and they call me and say, hey, Gabe, I'm going to buy a new primary residence. As long as I roll over my gain, I don't have to pay any taxes, right?
That's a common
Right, because that goes back to the 80s that rule
I don't
used
even
to
know.
apply, but long time ago,
Yeah,
needless to
long
say.
time ago.
And then I said, no, that rule has changed, and now there's what's called Section 121 of the IRS code
Correct.
for primary residence, and then they say, okay, well, how about a 1031 exchange?
Yeah.
I say, no, that has to do with investment property. So, with that being said, talk to me a little bit about again. Let's break it down to a primary residence first
Sure.
and foremost. What are the rules associated with, you buy a home for $500,000, okay,
Yeah.
and 10 years down the road, assuming you've lived in it, right, and such, 2 of the last 5 years as your primary residence. What are the rules around the taxes and the long-term
Sure.
capital gains associated with that?
Yeah, absolutely. So I think talking about selling your primary residence and the 1031 exchange is good to combine those conversations, because I think that's what confuses people, is that they've heard of 1031 exchanges,
Sure.
so they think that applies to their personal residence, where yes, they sell their residence hopefully at a gain, and these days, no matter where you live, you're most
Hopefully.
likely selling your residence at a gain. That if they think they have to roll it over into a similar property or more expensive property to not have to pay taxes on that gain. But again, that's a 1031 exchange, and it is not applicable for your primary residence, your personal residence. So when we're talking about specifically selling your personal residence, again, let's say you bought it for $500,000, now it's worth, especially around here, 1.5, right? They have a sizable gain, regardless of whether they go live in a van for the rest of their life or buy a less expensive property or even a more expensive property. That doesn't matter when it comes down to the taxes on that gain. Let's assume that's a married couple. So married folks have the ability, which you refer to as a Section 121 exclusion. I don't like to talk tax codes very much, but was one of the ones I actually can memorize.
Sure, yeah.
What the IRS does allow folks to do is to exclude a certain dollar amount of their gain when selling their primary residence. For a married couple, that is $500,000 is the maximum amount of gain they can exclude. It's not a deferral; it is a complete exclusion. So in our example, if it's a $500,000 when we bought the house, now we only sell it for $800,000, we can exclude that entire $300,000 gain. There is no tax liability at all. You still have to report it, but you can't exclude it. For somebody who's not married, so somebody that's single, let's use the same numbers. They can defer or not defer. They can exclude up to $250,000. So basically half of what a married couple can do.
Sure.
So in that example, they bought it for $500,000. They sell it for $800,000. They can exclude $250,000. They will still pay capital gains tax on the other $50,000. So that's how the math works, and it is an exclusion, not a deferral. To qualify for this exclusion, you kind of mentioned it in passing there. The requirements are generally, it gets a little more complicated, but as long as you've lived in it as your primary residence and owned it as your primary residence for 2 out of the last 5 years, then you can qualify for that exclusion.
Got it. So just to break that down, you've lived in it for 2 of the last 5 years, so you've owned it for 5.
Yeah.
You lived in it for 2. You rented it for maybe 1 or 2.
Yep.
Still can be considered a primary residence.
It still can be, yes.
And as long as it has been your primary residence and you meet the requirements there, then the first $250,000 for an individual and the first $500 for a married couple, capital gain
Right.
is tax free.
That's correct.
Right.
That's correct.
Now, with that being said, you talked about a $500,000 purchase price and a future sales price. Correct me if I'm wrong, but when you talk about $500,000 purchase price, you're really talking about the cost basis.
Correct.
Right? And the cost basis is a combination of your acquisition price plus any significant capital improvements at the same time. So if you did a major remodel and you put $100,000 into the home,
Yep.
that $500,000 purchase price plus the $100,000 becomes a $600,000 cost basis. Is that correct?
That's correct. That's one good thing for homeowners to keep in mind, because a lot of times maybe people realize that they can exclude a fairly large sum of money from their primary residence sale eventually, so they don't bother keeping receipts for or records of major improvements that they've done to their house. So that I've had clients, they've been there for 50 years and they bought a house for 20 grand or 50 grand 50
Sure.
years ago, and
Yeah.
now they're selling it for 3 million. It happens, right? Especially
Yeah.
around here. And now we're trying to go back and say, well, obviously to sell it for 3 million, you must have done some really significant improvements over those years. How do we come up with those records? So I guess the moral of the story there is keep your records now when you're doing major. Now, if you're just doing a little repair here and there, that's not really going to add to your cost basis.
Sure.
But you remodel a kitchen, you remodel a basement, or finish a basement, I guess, remodel a bathroom. Those are the most common things that are done.
Sure.
Maybe even add an addition. Make sure you keep those receipts and those records.
That's a good tip. Yeah,
Yeah.
keep your receipts, and because eventually you will have to file that, as you said.
Correct.
Even though you may not have to pay taxes on that first 250 or 500 gain, still has to be filed, still has to be annotated, and it still has to be documented.
Exactly, and again, what we're seeing these days is even people living in their houses for only a few years, they're blowing through that $500,000 gain.
Yeah.
They're having, like I said, we started saying earlier, you bought it for 500, now you're selling it for $1.5 million, and you're married. Sure, you can exclude 500,000, but you still have an additional 500,000
That's right.
that you're going to get taxed on. So if you've done improvements over those years, we want to make sure we add that to your cost basis to reduce that taxable gain.
Yeah, which, by the way, if you're in that situation, you've got some long-term capital gains taxes above and beyond the
Correct.
exclusion. That gets into maybe the tax loss harvesting conversation that we'll have in a different day.
Absolutely, absolutely, yep.
But to come back full circle now to the 1031 exchange,
Yep.
just we talked about the primary residence. Now with a rental property or investment property, the IRS code, not to quote IRS codes again,
Yeah,
but
right.
the 1031 exchange references the IRS code.
It does, yep.
That's more of a business-to-business transaction and a like-kind exchange. So talk to me about that. piece
Yeah,
a
and
little
that's gone through some revisions in recent years as well, where basically the concept is if it's business or investment property, or it used to be just an asset. So, and you traded that in, for example, or sold it and bought something similar, you could defer the gain if you had a gain on that property. More recent laws have changed it to just be real estate related. It used to be you could trade in a vehicle, for example, and if somehow you had a gain, if as long as you reinvested the proceeds, you could defer the gain on that vehicle. I think it was 2 or 3 years ago they changed the rules. Now it only applies to real estate, so it makes it a little bit easier to think about it from that perspective. But again, it does only relate to what we would call investment property. Probably the most common thing is investment property or business property. I should correct myself. But usually we're thinking about rental property. Somebody owns a ski condo up in the mountains. They've had it for 10 years. They've been renting it out primarily, most of the time. Maybe there's some personal use there. Now they want to sell it. Maybe they want to upgrade into a bigger, ski condo or a single family home that they'll also use for rental purposes.
Sure.
If they probably have a pretty sizable gain baked into that condo, they want to sell it. They will have to reinvest all those proceeds into the new replacement property within a certain time frame if they want to defer that gain. Now, the difference between that and what we talked about earlier with your primary residence, that Section 121 exclusion, that is a full exclusion. You're not deferring the taxes. You're just basically getting a free pass on those taxes.
Right.
1031 exchanges are different. You're just basically kicking the can down the road, right? So again, I have a ski condo. I bought it for $500,000. I'm going to sell it for $1 million. I'm going to reinvest that $1 million into a new property for rental purposes. That $500,000 gain just gets deferred to when I sell the replacement property.
Yeah.
I don't exclude it. I'm just deferring it to down the road.
So you are literally kicking the tax can down the road, as
Exactly
you said,
right.
such that $500,000 acquisition on a rental property, you made $500,000 in that example,
Right.
And now you have a $500,000 gain. You sell it, you buy a replacement property of a like-kind property, right? And by the way, it doesn't have to be another ski condo.
Right.
You can go out and buy a 4-unit rental property.
Absolutely.
Right? Just to be clear, not to get into the weeds of the rules.
Right.
But you go out and buy another rental property for rental income purposes. And now that $500,000 gain is rolled into that property
Correct.
and deferred until that's sold
Correct.
and potentially do another exchange.
Exactly right. And that's, we have, I call them serial 1031 exchangers, right? Which is not a bad strategy because, again, if we're talking about just kicking the tax can down the road, eventually you're gonna pay the piper unless you're a serial 1031er and you just constantly reinvest the proceeds every time you sell a property, right? You just keep reinvesting and reinvesting. And then eventually you die with that last replacement property. Under current tax laws, that tax liability that you've deferred for all those years basically vanishes and nobody pays tax on that.
Interesting. So not to get into the weeds on that, but just kind of wrap this conversation
Sure.
up. If you did a 1031 exchange in multiple exchanges and you literally kick that tax can down the road indefinitely, and once you pass away and your estate inherits your assets at that point, are you saying they effectively get a step up in tax basis to fair market value and
Yep.
under current tax
Under current
rules?
tax laws, right? Yep.
Yeah.
So whenever you're watching this, who knows what will be in place at that time?
Yeah, in November of 2021, right now. However, in January it could be very different. But no, this has been awesome, Mark. Thank you so much for helping to clarify, because I do get a lot of questions from clients in regards to this topic, especially as they're selling a primary residence and such. Any other last minute tips on this subject?
No, but the reinvestment of the proceeds of the house you sold, if you, let's say you only reinvest half of the proceeds.
This is a 1031
In a
exchange.
1031 exchange,
Okay.
yeah. That, you still qualify, but now you only qualify for like half of the deferral. You'll pay tax on half the gain and defer the other half. So it's not, you don't have to reinvest the entire proceeds.
Yeah, good point.
So we see that maybe somebody's going to downsize their rental condo or something like that. So there, you still can qualify for the 1031. It just won't be the entire gain won't be deferred.
Got it.
So-
No, that makes sense. And maybe we'll have to talk about it another day, but I'm hearing it actually more often now is that where people are renting out part of their home
That's
or an auxiliary unit or a basement for rental income, and it's still their primary residence.
Yeah,
So we'll
that's-
have to talk about that one another day of how
That's
that.
a more complicated topic. Yep.
Yeah. Well, awesome, Mark. Really appreciate your time and insight to this topic. So
Awesome.
thanks again.
Yeah. Thanks for having me.
All right.